So with that, Anne, I would love to introduce you. I, could say so many things about you. I'll just say that, of course, you have been the co-founder and managing partner of Floodgate for now over a decade, well over a decade. You're also a wonderful professor at Stanford, which I had the pleasure of having you for. But with that, I would love to turn it over to you. Could you maybe take us back to 2006? You were halfway through your PhD at Stanford. How did you become a venture capitalist?
Yeah, so actually, before I came back for my PhD at Stanford, I had worked for 5 years. So I was kind of an old timer when it even came to my PhD. And the reason I'd gone back for a PhD actually was I was seeking out technical depth in a particular area where I was interested in starting a company. And the company I wanted to start was in the space of cybersecurity risk management. And I'd started the PhD actually at a point in time when it was controversial whether or not you needed to manage risk or if you just needed to control security entirely through the use of technology. And so I'd seen the evolution of the space where people were then by the end starting to develop even cybersecurity insurance. And so I felt like I was kind of early in this whole trend, had really good technical skills in the space and was going to start my own company. But at the same time, I had been also TA for a variety of entrepreneurship courses in this School of Engineering. And the person I was teaching most closely with was actually this guy, Steve Blank, who had written The 4 Steps to Epiphany. He had not started blogging yet. So he's well known for that book, but not so well known. And so we just started riffing on different classes that we could teach together. And he was actually a very important figure for me because he said, hey, you should just start a company. You should go in and find out what other entrepreneurs are doing today. And it was really important advice because I had seen entrepreneurship, in 2001, 2003, but I hadn't seen it in about 3 or 4 years. And a lot had changed. So in 2006, many of you know, AWS came out. And so I decided to go out and ask a few angels that I knew whether or not I could see their deal flow. And Mike Maples was nice enough to say yes. And so every Wednesday I would go and see all of his deal flow. And the thing that I gave back to him was like my unfettered criticism of different companies. And we discovered we really liked working together. Like he was this eternal optimist and I was kind of like I would hold my nose with certain technologies and I would be pretty opinionated about things. But we had sort of similar values when it came to how we wanted to treat entrepreneurs. And we both had this background, he from an entrepreneurship side, mine was from my working background, plus my few years in the PhD program, where I knew actually the cost structure of these businesses was fundamentally changing. And so the investment needed was actually changing. And I knew that these venture firms actually were not set up to go after these opportunities at that time. And there were only 3 or 4 other companies doing it. And so Mike and I decided to start Floodgate. And I think the moment I knew it was right was, we had maybe 3 or 4 other competitors in the space. And I started to tell people this is what I was going to do. And I got all these people saying, oh, you shouldn't start your own venture capital firm. Like, who does that? No one does that. It was true, actually, no one really was starting their own venture capital firm. And they would say, if you really want to do that, let me introduce you to one of these larger firms where you could be an associate. And I remember just getting super mad and just saying, I don't want to be an associate at a big firm. Like, I want to start my own thing. And I know that this is right. You might not think it's right, but I know it's right. And I had actually a lot on the line, right? I hadn't finished my PhD, so I was going to do that kind of on the side whenever I had time. I had an 18-month-old daughter. And within 6 months of starting Floodgate, I was pregnant with our second child. My PhD advisor was still sort of on my tail about finishing. And I wanted to do a good job as an investor. And so for me to say, like, I believe this is an opportunity and I want to pursue it wasn't just sort of something that I was saying for kicks. And it was a time when most people thought it was stupid. And in fact, the reason that I was doing it was because I couldn't get a job elsewhere. That's what most people thought. So it wasn't like I could brag to people about the fact that I was starting my own firm. But the fact that I wanted to still do it was proof point to me that it was a right decision.
Yeah. And thanks so much for sharing so much of the behind the scenes in your decision process there. I'm sure a lot of audience members are feeling the same. And so there are so many threads we could pull on. So I definitely want to come back and talk more about your relationship, starting with Mike Maples. And I also wanted to take us back to the context around '06. I know you've shared with me some amazing stories. You know, I think you had to go in the closet where the old servers were and kind of run that for your PhD group. And I know also in some of your work experience with CRV, you were really looking at trends and ventures. So maybe take us back a little bit and talk more about what was that context that gave you conviction?
Yeah, so my second day of work at Charles River Ventures was 9/11. And so one of the first projects that I got to work on was figuring out what the size of the fund ought to be. And so I worked with the partner that I was assigned to, Ted Dintersmith, who's still a mentor of mine. He was trying to figure out like what's going to happen. And I remember I ran all these different numbers and I started to believe that there was this huge capital overhang in the venture industry. And it used to be like you would have IPOs every hot second. And then all of a sudden there was nothing. There's literally no activity. And so CRV at the time was sitting on $1.2 billion. And I was just an analyst. Like I didn't know anything about the VC business model of like management fees and carry or anything like that. And I remember I came back and I was like, I think the right size fund is somewhere around like $350 million. And the partner I worked with like worked through these numbers with his partnership and they came back with, we think the right number is about $450 million. And at the time, I didn't actually appreciate what it takes, the courage that it takes to actually right size a fund in the midst of deploying that fund. But CRV, just the people around the table, I can tell you are just high integrity individuals, and they decided to do the right thing. And so I knew that dynamic. I also knew sort of from a large fund's perspective, even with $450 million, how much you have to deploy as a check size. So that was sort of an interesting background for me. Then the second one was in 2008, as I'm starting Floodgate, 2 years before, as I mentioned, AWS had been launched, and we had, as a grad student group, we were very fascinated by just cloud computing. And part of it was there had been a whole wave of what was called web services before, and web services hadn't quite taken off. But for some reason, people felt like AWS was different. And so some of the debates that we were having internally was like, why is it different? How is it different? How will it be different this time? But some of it was actually like people wanted to play with this. And I remember my group actually really wanted to put some stuff up in the cloud to access actually the compute power, but also just the resiliency of having it in the cloud. And we were right next to my office was a series of server racks that the grad students had to sort of keep up. And it was like the bane of our mutual existence. And there was something about like, hey, if you didn't actually have to deal with this hardware anymore, there would be magic there. And there were other advisors who allowed that to happen. And I remember thinking like that was actually a really big deal, that they weren't putting everything up into the cloud, but there was movement there. And that to me felt like a real important observation, which then led to Floodgate getting started and 500,000 being that new benchmark for investment. It was important because again, at CRV, the typical investment, this was not just for CRV, but just across Silicon Valley and venture capital, was you would invest $5 million for 50% of the company. And I think most people are like, that is insane. But that's just sort of what it was before. And to be honest, like I blame the microfunds like Floodgate for ruining that as a business model, right? We are now, like, we came in and said the value proposition, $500,000 for, 10%, maybe more of your company. But it was interesting just to see that business model shift happen so fast.
So Floodgate really was at the cusp of disrupting traditional VC in a way, riding on the backs of AWS, which allowed companies to get started at a much lower cost. And so it didn't take 5 million to get started, and that's why 500,000 made a lot of sense. I do want to go back to your CRV bottom-up analysis.
Yeah.
Traditional fund, billions it can raise and can deploy. You mentioned that you only realized later on the depth or the heft of what you just recommended, but seems like they came close to it. What is your reflection? I know fund size is a deep topic, and I think Mike has talked about it also. It is a function of, I think he positions it better. Like it is what your strategy is. Can you talk a little bit about your experience from that CRV experience leading to starting Floodgate? How has that morphed your thinking around fund size in general?
I think it's really influenced it pretty dramatically. So I think, so there was actually, it wasn't just the AWS cloud computing piece that was really important as a shift. The other thing that I noticed also teaching these classes with Steve Blank was that even in the early 2000s, there was a very large sort of technical heft to the companies that were being created. So there was more technical risk than market risk. I think the subtlety of what happened with cloud computing, with open source, and now we're getting to no code, right? Is that actually the technical risk is much lower than the market risk. And testing out market risk is not as expensive as testing out technical risk. That was like a critical observation that I think Mike and I were early on to, partially because he was an entrepreneur, but also I was sort of in the midst of seeing like hundreds of companies being formed at Stanford, right? And so I could literally observe that in my own backyard. So I think that was important. For me, like, I think the reasoning that I have for fund size, part of it is driven by what Mike has said. It's sort of, you have to have this preparation to be able to return the fund or multiples of a fund through one single investment. So that, I think that's really important. But I think it also speaks to the type of entrepreneurs that you actually want to back. So if you take a typical $100 million fund, to be in a top 5% class as a firm, you have to return 3x the fund. So that's $300 million, right? And obviously you don't own 100% of the companies you're invested in. So you basically have to then backtrack into how big does the exit need to be in order for me to start to return that amount of capital. Well, typically you're going to have to at least 20x it, because maybe that one investment is the investment's like 5% at exit, right? Smaller funds, actually, it's harder to get to that 5%. So it might be even higher. So you're now talking about a cumulative market cap of $6 to $10 billion, right? So like, you sit on that for a second, you say to the entrepreneur, by the way, this is my incentive, right? I have $100 million fund. Like, I have to deliver for my partnership $6 to $10 billion of cumulative market cap. So if your company gets an opportunity to sell at $100 million, even if that nets you $50 million, I have no interest in participating in that. That is a huge misalignment of incentives if the entrepreneur isn't crazy enough to look at $50 million cash back to her and say, you know what, this is a $10 billion company, so I'm going to say no to that. And so that's the hard part.
Yeah, you're getting into a lot of the complicated dynamics that kind of even weigh in different directions. You know, the bigger the fund size, the more you need to return, the smaller, the less, but the harder maybe to get ownership in certain companies. And so that plus the incentives and how you work with entrepreneurs. So I want to definitely go in both those directions. So maybe we talk about the first Floodgate fund. How did you weigh all that? And maybe you didn't know all of it as clearly as you know now, but how did you decide how much to raise in that first fund?
I don't think we really had quite an art or a science to it. Mike used to say it's whatever you can raise in a month. And so he just basically walked into a conversation, realized that they were ready to write a check. And then we had this wonderful woman, Catherine Gould, who was a co-founder of Foundation Capital. And she was like, well, you're fundraising now. And then she basically helped march us into a couple of other groups. And once 3 investors said they were in, that was our fund size. It was $35 million. And 35 felt like it was manageable. And like from there, we said, okay, if we can do $35 million for our first fund and it was feeling good, then, and I actually refused to make an investment for a year. So I would just follow Mike around and he's like, you can write a check. And I was like, no, thank you. I just want to keep like just learning and seeing. And when I'm ready, I will write a check. And so I felt like I was slow in onboarding myself and getting ready to write that first check. And so I only did 3 investments out of that first fund. And then the next one, we decided that I would be sort of all in on making investments at a similar pace to Mike.
Holding back is counterintuitive, right? When you have the capital, you worked so hard on raising the capital. The whole goal is to invest, and everybody gets excited and starts jumping in right away. But I guess you had the prudence to take it slow, take it easy, to make sure you're deploying capital in the right way. Was it an obvious choice that you made? Was it some guidance you had received? Like, how did you think about taking the time?
Yeah, I mean, it's a good question. For me, I wanted to take it slow. And I know for a fact that this business is a apprenticeship business. And so I'd spent 2 years following Ted Dintersmith around, and he was incredible. Like, I learned so much from him. He was, and for each person that I felt like I had the opportunity to really observe, they just had different skill sets. So Mike is very different from Ted. And I'm probably more similar to Ted in some ways, but part of what was really an interesting driver for me to attach to Mike was the fact that he was so different. And so Mike, Ted is a PhD as well, like in math modeling as well. And he's very introverted, but he was one of the most amazing networkers I've ever seen. He never networked in the sense of just like shaking hands and kissing babies, but he really knew so much about people and would connect with them. And he was like brilliant. Like he was always reading all these things, and he was like very mathematical, but like he could make up poetry. It was really amazing. And so I just loved spending time with him. And then Mike was kind of the same way. Like, I just really like spending time with him. 12 years later, I still love spending time with this guy. Mike is like probably, if I were to say the top 2 or 3 brilliant marketers in the world, like he's in those top 3 that I've ever met. And he just thinks about the world in such a different way and the way he uses words is always just super fascinating to me. And then he operates in this just high integrity way that like everyone can't help but love him. And so I don't know, for me, I could have just started writing checks, but I would have lost this opportunity to observe someone doing some incredible work and being able to say, hey, that's something that I can adopt for myself, or say, I like the way he does that, but that's not me. And just put that in my pocket of like incredible superpowers that someone else might have. And so I can't say enough about that opportunity to sit and learn. I think these days it's true. Like I see a lot of people who are just itching to write that first check. But what's the point of that if you don't really know what you're doing and you're learning on someone else's dime? Why not learn from the very best and then understand what you can bring to the table alongside that as a metric? Like I want to know what to measure myself against.
Yeah, and you spoke about shadowing that first year with Mike. You also were really learning from him the couple years you were finishing your PhD too, when you were looking at deals informally, and you did have several years with Ted. So I think by all measures, you really invested in that apprenticeship period. And I'm curious if you could share what were the most important things you learned, whether it's behaviors or ways of thinking.
Yeah, I think the first was what I've already mentioned before is like, I always thought networking was like, you had to go into like one of these big halls and collect a ton of business cards and like kind of memorize faces with names. And I just saw a different style with Ted that I felt like I could do. It was the first time I'd ever seen someone networking in a way that like felt authentic and real to me. So that was really important to just know. The second was actually the different types of board members that you might observe. And I got to see this in sort of really hard times, 2001 to 2003, the work that is required when like things are not going well, and seeing the people at CRV really rolling up their sleeves and doing that. I got to witness that. So it wasn't just like, what does a good board member do when things are going incredibly well? It's, you know, what does it actually mean to be a board member, to provide governance, to provide great advice, to be the person that the founder would call when things aren't going well. And then with Mike, what I got to see firsthand was just sort of how do you actually think about high-paced investing. So I remember the first day, like after I like said, okay, Mike, let's like really make a go of this. We were looking at a bunch of investments. It was the first time where I wasn't just sort of telling him what I thought, but now I'm like in the process of, okay, should we make this actual investment? Should we allocate dollars against this? And we had seen a couple of companies in one day that were very interesting. And then sitting down and saying, okay, if we were to only invest in one, which would we do? Which was so different from Series A investing at CRV, especially in 2001 to 2003. I never had to compare deals against one another, right? Like if you had one deal that you were really interested in, that was really good. So it was just really interesting to have a pacing change happen like that. And so it's just a very different perspective to bring. And then actually watching Mike as a board member, very different, because he's much more sort of positioning oriented. He's thinking about product in a very different way. He's really incredible product marketing. And so just having him think through, okay, what are the analogies of this company, this product, this business? He's probably one of the best when it comes to analogous situations, businesses. And so when I look at that, I'm like, this is really awesome to just watch, observe, and like try to absorb.
And talking about companies, can you take us back to how you got excited about Zimrides? Because it's very different from your domain expertise, your PhD program, cybersecurity, things like that. But how did you? What was that process by which you got excited about Zimrides? And then obviously people know it as Lyft today. But I'm very curious about the origin story there for you.
Yeah, and it's interesting because this kind of origin story may not happen as often today, just because there's so many more types of startups available. But back then, there was actually no startups talking about transportation. And so that's what was interesting to me. So when we went and looked, the most recent startup was Zipcar. So I actually called Scott Griffith from Zipcar to understand sort of the dynamics of the transportation startup industry, did he see anything? Because like as the CEO of this company, he was probably seeing some other transportation startups. And in reality, he hadn't seen much. And he was like, oh yeah, this is probably one of the more interesting businesses I've seen. And to me, that was like, I was floored because transportation, as we've all now seen, is such a huge industry. And so when John Zimmer was explaining like the importance of transportation is that actually the shape of the way transportation evolves in the United States in particular changes the actual social fabric of a society. It's like changes the way cities, towns are structured, where they go. And to me, I was like, oh yeah, that's definitely true. And this was just when Facebook was taking off, and they were saying, you know, there's something in the social network that enables people to trust each other a little bit more. And so especially if you're in the same network, so if you're in the Stanford network, you can actually find people in common with you. And so people will be more open to sharing the ride. And so that was the linkage that they were making. And as a result of that, they had sort of this connection to social is going to change the way transportation happens. And I bought into that. I think sort of my lens has changed a little bit in today, like what I really look for, which I would have found in Zimride. There are two elements that I really still look for. One is that they were really fast builders. So you would talk about something, and if they couldn't create it in code, they would create it physically and just do it. So I remember one board meeting, we were talking about van rides and the fact that there's all this like Craigslist activity around people actually transporting each other to LA, and they would rent vans to do it. And the next thing I know, Logan Green, the CEO, has rented a van, is put something up on Craigslist to just test like how much demand is there, and is doing this on a regular basis. You could see it also in the software product. They were just really fast, like you couldn't keep them from building product. So I love seeing that. The second piece was they knew more about the history, the government relations, the complexity of the ecosystem, the various interest groups, why people would actually join a car ride or not, better than anyone I had met. So I call that sort of the traversal of the idea maze, but those people are super thinkers. So we're always looking for super thinkers or super builders, and you need to have both in order for that like early stage business to move fast. And I think like for me, like if I say what's my superpower, I'm really good at sniffing out super thinkers and super builders before other people can find them.
Annie, you mentioned a little while ago when you first got started, you were advised to become an associate at a larger fund and go under their wings, but you chose to chart your own journey to co-found Floodgate, and you've done tremendously well. Many of the folks who are going through the Angel to Fund Manager program are on a similar journey. And one can argue that fundraising has never been easier than ever before. There are rolling funds, syndicates, things like that. At the same time, it's very, very crowded, hundreds of funds every year, and standing out is so difficult. If you were to, first of all, what's your perspective on the cycle that we're going through right now, especially as Floodgate kind of led the previous cycle? What do you think is going to happen now? What do you think is going to come out of this?
Yeah, I think that's a really good question. It's interesting because people have asked me if I would still start Floodgate today, and I struggle with that because I think on some level I've always liked being different. And so, I mean, like I remember even going back for my PhD, having worked for 5 years, people were like, this is a really bad decision. Like you should go, if you think about like, you know, some very successful people at that time went into industry, went to Google pre-IPO, right? And I decided to go into my PhD program. And part of it was like sort of this feeling of, I don't want to do the same thing that everyone else is doing. And so I feel the same way actually about venture capital. Is it's really hard to stand out. I don't know. And I kind of like to be in a situation where it's easy to stand out. And so in the early days of Floodgate, it was kind of easy because there weren't that many people writing checks that were $500,000. So you could kind of like just put your sign up and like people would come. And then like, let's like also talk about the fact that there weren't that many women. And so, you know, I remember I really wanted to go to this one conference and like, I couldn't get an invite because they didn't want so many VCs there. And my argument was like, you don't have enough women there, so why don't you take me? And so I think like, I don't know, that, you know, Mike always likes to quote Jerry Garcia from the Grateful Dead. He used to say, don't be the best, be the only. And I kind of like that. I've actually said that to my kids before, like, why play soccer when everyone else is playing soccer? Like, this is completely self-interested, but I'll say, why don't you do like competitive barbecue? You know, like do something that no one else is doing, because then it's easier to be the best. So that's the way I think about it. It's and so if you're coming into VC, don't do the VC path that everyone else is doing. Figure out like, what is it that no one's doing, and figure out why. So it's not good enough to just be different, because it might be that you're different and no one's doing it because there are good reasons not to do it. But understand the dynamics of why. And if there's no good reason, then you should enter into that space. Is something that like I like to talk about when I'm talking about diversity to my portfolio companies, is that a lot of people think it's like this do good thing, right? Like, oh, we're going to be like racially more diverse. We're going to have more socioeconomic diversity, and we're going to have better gender diversity. I think that's just like totally the wrong way to look at it. The way I think of it is, in Silicon Valley, the language that we understand is network effects, right? And with each additional hire, the argument I provide is we should be seeking out network effects. And if I'm only hiring from my own network, I haven't created any network effects. The first time I go outside my network and I pull on another string of networks, like that's creating network effects. And they show this actually in economic studies. So there's a book called The Good Economics for Hard Times. And in it, they actually have this really interesting study where they take people who were little kids who were put into play groups that were very diverse from a socioeconomic background. And then they had others that were more segregated. And then at the end, they said, okay, you can now go and pick your own sports team. Well, it turns out the kids who are stuck in their own socioeconomic, non-diverse groups ended up picking the best players from their own socioeconomic groups, right? But the kids who are from diverse play groups were unafraid to choose the very best player, no matter what they look like. And so I was just saying, that's amazing, because what that proves is the more touch points you have into a diverse world, the better off you are in creating new network effects. And so when people say it's like, it's the right thing to do, I'm like, who cares about the right thing to do? It's the greedy thing to do, right? And I think like David Swenson understands that. So he's trying to create that within the investment managers he's invested in, because he knows that that's going to create better investments, better investment decisions, and just overall like a better endowment for him. And so I love that notion of think greedy. And even if it's for a particular hire, again, this is where like some of our founders will say, well, for this particular hire, like I really need this particular person. And I think that's also just a little bit too myopic. So I'm always saying, let's look at what's best for the organization, not right now, but I'm assuming you're going to be a legendary organization in 2-3 years. Let's do what's best for that organization, and not just for this small role, but for the team, or for the business unit, or for the whole company.
I think you brilliantly articulated something that a lot of people kind of intrinsically feel, but we can't articulate in the way that you did. We in our AFM program, we had about 45% women. Many of them are diverse. Do you think what Yale is doing is going to be replicated by other LPs, where folks who don't have traditional backgrounds, they're not from the right schools, or they're not in a certain, they look different, they come from different backgrounds? Do you think it'll become easier for them to fundraise because Yale has kind of put the flag down, and then so others will replicate over time?
I think so, but I think also what it's going to cause people to do is actually hire more diversely. So part of it is most of these, like, let's take a PE firm. Where do they hire from? They're hiring from McKinsey and Goldman Sachs. So if McKinsey and Goldman Sachs isn't more diverse, like, the PE firm is like, well, we can't be more diverse, like our pipeline. And so the point is, well, why are you hiring from McKinsey and from Goldman Sachs? Like, at that level, if you're hiring junior talent, as I said, it's an apprenticeship game. Like, you don't need that training to be successful. And so hire better people from lots of diverse backgrounds at that point. And you create actually the pipeline. And we're aware that, by the way, then you have to make these people successful. And once you start gathering the data, which an organization like Yale has done, you can actually start to hold people accountable. That it's not just make me look good metrics, but rather a deep commitment. And my hope is it's a deep commitment because it is the greedy thing to do. Like, once you start doing it, you realize, oh, this isn't so bad. This is actually a really good thing. Right?
One of the things that many emerging fund managers do is like large institutions are happy to meet them, but they probably won't commit early on. Maybe not in fund one, maybe not in fund two, and so they have to talk to family offices and then a host of others who are trying to figure out what is different about this manager versus this other manager. And it's what companies are you part of? What companies are doing well? What do you think? You speak to LPs all the time. I'm sure all types of LPs. What would you say with an LP lens that folks who are just getting started should think about as their first fund, as their sort of first set of LPs that they want to pull together? Should they be bringing should they be building relationship with folks like Yale early on, with the hope that something might happen later down the line? Is that something they should be doing, or should they rather be just focused on closing folks who would commit for the first fund immediately? How do you think about LP relationship management, I guess?
Yeah, and I think sometimes this comes back to what Mike said. Your fund size is whatever you can raise in 30 days. Maybe 30 days at this point is a little bit too short, but I do think, like, sometimes people set a number and then they're fundraising forever. And I just don't think that's a really good dynamic. It's just like, raise what you can and then get back to work. Having relationships or starting to set up relationships with a larger fund of funds or endowments is always a good idea if you can get an introduction to them. I think that the other piece that I would think through, and this is just sort of just general good interviewing advice, is I remember when I was in college and I was looking at my resume and I was about to send it out, I realized that, basically all of Yale was interviewing for the same positions I was interviewing for. And if you put yourself in the shoes of the interviewer, they're talking to you for an hour, but it's like back to back to back for an hour. And at the end of 10 hours, they can barely remember one person from the next. right? And I imagine the same thing for LPs, like it's the same kind of pitch every day, in and out. And so I've always said I remember I said this to myself, I say this to my students, but it's always saying, what's your tagline? And what's the tagline that no one else will have said? And I was really focused on that. Like when I was interviewing, I had like 2 stories that I would always tell. And it didn't even matter if they asked me a question about it or not. I would manage to jam that story in there all the time because I wanted them to be, I imagined them sitting there at the chalkboard, the whiteboard saying, Ann Miura, she's the person who, and then everyone would be like, oh yeah, I remember her. And I think that from an LP standpoint, when you think of who are you and what is your differentiating power, that's really hard, right? Because if you're like, well, I'm an Airbnb alum, how many Airbnb alums are there, right? Well, I invested into this company. How many other angels invested into that company? I am an engineer. Great. How many other engineers are also angel investors? So what is your different? What allows you to win deals that other people couldn't win? And what's going to cause an LP to remember you? And so I think like that's sort of a very, very critical piece of the puzzle of why do you have unique deal flow? Why will you uniquely win?
We had Brian Singerman from Founders Fund earlier this morning, and he talked about something very similar, which is how like lean into your, I think the way he characterized it, he said lean into your moat, your personal moat, your difference, and just double down on that. His
what was Brian's difference? I'm so curious.
He made it a point to say that whatever worked for him may not work for others, because I think he had a Google and Stanford connection. He knew the folks at folks like Sean Parker early on, and he wrote that. And I think what really resonated was that he says he has no rules. So if it's a great company, he has no FOMO, no rules. Ownership doesn't matter. He just wants to put as much as he can into the best companies and sourcing and all this.
He has a very clear strategy too. I mean, I think he's always like, if you want constant like coddling and helping from me, like we aren't the right fit for you. And I was always very respectful of Brian on that front. I agree with him. Like, again, for me, like I always felt like I had to, and I would say my superpowers have changed over time. But like in the early days, I leaned into the fact that I was still finishing up my PhD as a Stanford student, literally had an office there. I was teaching. I still am teaching. And so I actually literally teach year round in the School of Engineering. So I teach every single quarter, even the summer quarter. And I'm the co-director of the Mayfield Fellows Program. And so I do actually have a pretty deep connection into Stanford itself. I'm also, because of my PhD background, I'm close to a lot of the professors there. So my one of my co-advisors is the chair of the CS department now, right? And so there's different ways in which I've created sort of unique networks for myself. And then the other piece for me has been sort of also stylistically, how do I work with founders? And some of it is sort of similar to Brian. Like if you really need gold stars from me, I'm not your gal. Like I am the person you want if you really need someone who will honestly tell you if you have, with a skeptical lens, whether or not you have product market fit. And I have a lot of different frameworks for assessing that. I'm pretty brutal when it comes to it. And whereas I know a ton of other angels who are incredible fans and will build up that person, I'm probably more of a dream killer, right? and so if that doesn't work for you, it's really hard. And so some of what I'm looking for is, does the person like to engage in like a pretty heated debate? Like I really like to explore ideas by disagreeing with people. And if you just sort of wilt under that pressure, that relationship won't work. And so the best people that I'm working with, like they'll send me a document and I have like 50 comments on the side. And they're mostly questions. We're just debating things. That works really, really well for me. But I know that there are founders who don't like that. And so in that case, they shouldn't work with me as a partner. And so for me, like there's certain things stylistically that have to really work out, especially at this very early stage, pre-product market fit. And then there's sort of, I have to have affection for the insights that you have. And as long as we have these like critical pieces, I'm all in. And the style for me is I'm all in until I'm not. And you will know when I flip the bit, but like there will be a lot of reasons as to why I flip the bit. It hardly ever happens, but Mike has said, oh no, Ann's getting really close. But the thing that I always try to do is every founder knows where they stand with me.
Yeah. And well, this has been gold right up until the last minute. And we're so appreciative of you for spending all this time with us and with our audience. So we want to say thank you. Any last words from you as they make the go, no go decision to be fund managers?
You know, I would say again, like find your different, follow your different and embrace it. But more than anything, I think, you know, these days, like there's a lot of desire to seek heat and follow heat. But in my long history, what I found is companies that are kind of ignored or in sectors that people haven't noticed, those are the ones that actually are the real winners. And so look for that. It's not only follow your own different, seek out different, because it's not where, especially if you're early stage and if you're an angel investor, those are the places where the best investments happen. It gives you the time to do it. It gives you the time to notice, the ability to develop relationships. And I think that's underappreciated today.
Wonderful parting words. And thank you so much for taking the time again. Thank you to Floodgate also. Wonderful.